The chancellor should cut national insurance and increase income tax to create a level playing field and protect workers' pay, a think tank has said. In a report published on Tuesday, the Resolution Foundation said the chancellor should send a decisive signal that she will take tough decisions on tax to calm jittery bond markets. It comes as Ms. Reeves prepares to deliver a budget in November that is widely expected to see significant tax rises as she battles to meet her fiscal rules. Among the tax changes proposed by the Resolution Foundation was a 2p cut in national insurance, matched by a 2p rise in income tax. The think tank argued that the switch would raise $6 billion and help tackle unfairness in the tax system, as income tax is paid by more people, including pensioners and landlords. But the change would provide only some of the $20 billion of tax rises the think tank estimated would be needed by 2029-30, thanks to a combination of increased borrowing costs, lackluster growth, and new spending commitments. Adam Corlett, principal economist at the Resolution Foundation, said cutting national insurance and increasing income tax should form part of wider efforts to level the playing field on tax. Other proposals put forward by the think tank include increasing the tax on dividends, addressing a worrying growth in unpaid corporation tax from small businesses applying a carbon charge to long-haul flights and shipping, and expanding taxation of sugar and salt. It also proposed gradually reducing the threshold at which businesses pay VAT from $90,000 to $30,000, saying this would help promote fair competition and raise $2 billion a year by 2029-30. Mr. Corlett said, "Policy U-turns, higher borrowing costs, and lower productivity growth mean that the chancellor will need to act to avoid borrowing costs rising even further this autumn. Significant tax rises will be needed for the chancellor to send a clear signal that the UK's public finances are under control. Any tax rises are likely to be painful, but given the fallout from the recent employer NI rise, the chancellor should do all she can to avoid loading further pain onto workers' pay packets." The report came as the boss of one of Britain's biggest companies warned the UK faces a perfect storm that will hit economic growth unless the government takes urgent action. EasyJet CEO Johan Lundgren said ministers must urgently address what he called a perfect storm of challenges facing the country. These include soaring borrowing costs, a looming recession, and disruption at airports and other parts of the economy caused by strikes. He told the Financial Times that unless the government does more to support businesses, the UK could be facing a decade of stagnation similar to that seen in Japan in the 1990s. Mr. Lundgren said the UK is looking at a perfect storm and called for the Treasury to follow the Bank of England in acknowledging there is a serious problem. He added, "The big risk now is if we don't fix the fundamentals, we will end up in a situation like Japan in the 1990s where growth disappeared for a decade." Downing Street has repeatedly said it will stick to its manifesto pledge not to raise income tax, national insurance, or V8. And Business Secretary Jacob Rees-Mogg told reporters earlier this month that no decision has been made to raise corporation tax either. However, the Chancellor has already performed a U-turn over plans to scrap the 45p tax rate after it emerged that doing so would cost the Treasury $11 billion. And with borrowing costs expected to remain high for the foreseeable future, it looks likely that some sort of tax rises will be required when the Chancellor stands up in November. Jeremy Hunt told the Commons Treasury Committee last week that he will take whatever decisions are necessary to meet his fiscal rules, but he said he wanted to wait until the November budget to announce any measures, adding, "I'm not going to preempt the decisions that I might make on November. I'm not ruling anything out, but I'm going to take whatever decisions are necessary." Despite repeated denials from ministers, a YouGov poll found that almost half of voters expect tax rises in the upcoming budget, with most anticipating rises to national insurance or income tax. As well as calming financial markets, another reason for raising taxes is to try and bring down the country's enormous debt burden, which currently stands at about $3.3 trillion. Analysts at the Taxpayers Alliance said the UK's debt problem won't be solved through further tax rises alone. Tom Legatt at the TPA said, "Further tax rises would be a bitter pill to swallow for taxpayers who have already faced a decade of relentless tax rises under successive governments. More fundamentally, the only way to deal with the UK's debt problem is through sustained growth and reform of the UK's welfare state." However, the Director General of the CBI, Tony Danker, recently warned that if the UK wants to boost growth, it cannot rely on tax cuts alone and must also invest in infrastructure, education, and skills. He said, "The private sector cannot fill the gap left by the public sector, and government investment will be essential if we want to secure strong and sustainable growth. But we need to go further and faster than planned if we are to get the investment and the productivity gains needed to drive real wage increases and improve living standards." Despite the warnings, the Chancellor may still face calls for tax cuts from some quarters. Former Chief Secretary to the Treasury Simon Case said earlier this month that cutting national insurance would help ease the cost of living crisis. Writing in The Times, he said, "What we really need is a cut in national insurance, which would leave more money in people's pockets and help us to restore our standard of living. This is not the time for tax rises. We should look instead at ways of using our existing tax system more efficiently." It comes after research from the TUC found that workers on an average wage are $3,000 worse off than they were before the pandemic. The union said a combination of stagnant wages, rising prices, and higher taxes means the typical worker is taking home the equivalent of $3,000 less than they were at the start of 2020. Analysis suggests that if wages had kept pace with inflation, the average worker would be 3,700 oguns better off than they are today. Earlier this month, the International Monetary Fund, IMF, urged the UK government to do more to protect workers amid fears the cost of living crisis could push the country into a prolonged recession. The IMF said that households will see their disposable incomes fall by 4% next year, which it described as a highly unusual contraction driven by a sharp increase in energy prices following Russia's invasion of Ukraine and persistent inflationary pressures elsewhere. It warned that the UK is heading for the longest recession among G7 nations and is at risk of an extended period of low growth. Last week, the Bank of England hiked interest rates to 3% and warned of a very significant drop in living standards next year. And on Tuesday, official figures confirmed that inflation remained stubbornly high at 11.1%, suggesting more pain ahead for households and piling pressure on the Chancellor. A Treasury spokesperson said, "We have always been clear that decisions on tax are for Parliament, and we will set out our plans in the autumn statement.